Now, as we discussed, you have to transit from Indian GAAP to Ind AS. But now you'll say, where should this resulting adjustment be transferred? For example, if one particular item had to be measured at rupees 100 under your Indian GAAP, and that is why your balance sheet was disclosing the asset at rupees 100. But after application of the Ind AS principles, the value of that item is say 120. That instrument has to be recognized at 120. So one of the classic example is investments. Investments under your Indian GAAP had to be recognized at cost or market value, whichever is lower. But under Ind AS, all the investments by default have to be recognized at fair value. So if you have an investment in mutual fund, so cost of which is 100, under Ind AS, you have to disclose it at 120. What to do of this 20? How to give this impact? Where to give this impact is the question. So all the guidance have been given under the Ind AS 101. So what does Ind AS 101 say? You have to apply consistent accounting policies. So for your all the balance sheets, that is your current year, your comparative year, and your opening balance sheet, for all these three balance sheets, there should be consistent accounting policies. For your current P&L and the previous year P&L, there should be consistent policies. So in short, you have to apply Ind AS to all the five items. Okay. Now it says how to transit. So what does the standard say is, if certain assets and liabilities are to be recognized under Ind AS, which are not required under your Indian GAAP, recognize it. If there are certain assets and liabilities which were recognized under Indian GAAP and are not required under Ind AS, de-recognize such assets and liabilities. If any regrouping or reclassification is required, reclassify it. So if you see the Schedule 3, there's a drastic change in the balance sheet. Your Indian GAAP balance sheet starts at liabilities. Your Ind AS balance sheet starts with assets. Under your Indian GAAP, you had only current and non-current classification. Under Ind AS, you have current and non-current classification also, and also you have classification into financial and non-financial items. So in assets also you have financial assets and you have non-financial assets. In liabilities also you have financial liabilities and non-financial liabilities. So, if for the purpose of such Ind AS financial statements, whatever regrouping or reclassification will require, Ind AS 101 says that reclassify and regroup such items. And the last part is remeasurement. So, if a particular item was, as I discussed, was to be disclosed at 100, now it is required at 120, disclose it at or remeasure it at 120. So, four changes: recognize, derecognize, regroup, public, reclassify, and remeasurement, which is required under Ind AS. Now, the standard says whatever are the resulting adjustments on account of recognition, derecognition, or remeasurement have to be recognized in retained earnings as on the opening balance sheet date or any other appropriate reserve, whichever is appropriate to that particular transaction. So understand, friends, if you are applying Ind AS for the first time on 31st March 2017, for example, your opening balance sheet date is 1st April 2015. So for whatever transactions happened before 31st March 2015, and if there is any Ind AS adjustment required, so you had a investment in mutual funds as on 31st March 2015 at 100 rupees, you will disclose or you will recognize the additional increment of 20 rupees in retained earnings. So what will be your accounting entry is investment in mutual funds account debit 20 to retained earnings 20. So whatever was the gain on account of remeasurement in accordance with Ind AS has been recognized into retained earnings in the opening balance sheet date. Okay. Now, if any derecognition is required, so if this particular asset is not required itself in Ind AS, and on account of that you have to write off this asset, you will recognize it in retained earnings itself. So retained earnings becomes your basket. So whatever is debit or credit, you do it into the retained earnings or any other appropriate reserve as applicable. So if you are doing a transition of ESOP, if there is change in method, so previously you were following the intrinsic value method, but under Ind AS, this method is not allowed. So in such cases, whatever is the difference, one leg will go to the retained earnings and one leg will go to the ESOP reserve. So this is the case. And please understand standard rule. All Indies as good as are applicable from a retrospective basis unless there are any exemptions given. So understand this concept also. Ind AS 101 has given certain optional exemptions and certain mandatory exceptions. What does this mean? Optional exemption means what? The company has an option that they might use this exemption or they might not use this exemption. So for the purpose of smooth transition from your Indian GAAP to Ind AS, they have given certain optional exemptions. If you're okay with it, use it. If you're not okay with it, do not use it. For example, one of the example is if in case of your property, plant and equipment, the standard says that you can carry your Indian GAAP values as it is. Do not make any changes to the property, plant and equipment except one or two. So the company has an option. If they want, they can apply the entire standard of Ind AS on a retrospective basis, or they can use this optional exemption and carry that Indian GAAP values as it is to Ind AS. No adjustment required. This is for the purpose of smooth transition. The companies have assets from 1950s, 1960s, from where they will go and make adjustment to such kind of assets. That is why the company has given this exception for a smooth transition. And the second part is mandatory exceptions. What does this mean? This is mandatory in nature. If a particular standard, the Ind AS 101 said that mandatorily you have to apply this exception, you don't have any other option. So mandatory exceptions are given in case of say government grants. So in case of particular government grants, it has been mandatorily stated that you have to carry the value of the liability as it is. All the conditions are mentioned. But such are the examples where the entity does not have an option. Even if it wants, it cannot carry that government grant value in accordance with Ind AS, and they have to follow as it is whatever was given under the AS for the purpose of transiting to the Ind AS. So this is the case of how to give the resulting impacts and how to transit to Ind AS. I hope I've clarified and given you an overview of complete things to whom the Ind AS is applicable and how to transit for it. At least for the smaller companies, it will be very easy for you to transit if it does not have the peculiar issues into it, or if it does not have any complex transactions